Investing in a real estate can be a great option when you're willing to make the effort to acquire a profitable property. Cash flow, mortgage pay down, and tax advantages all make rental properties a great option for those looking to invest. Unfortunately, real estate is an extremely high barrier to entry investment. You'll likely need quite a bit of money to make even the smallest of investments. Keep in mind, there will be sleepless nights and deadbeat tenants who refuse to pay rent. For people who don't want to deal with the headaches with renting, you might consider a way that you can invest in real estate with less than $100 from the comfort of your own home. Real estate investment trusts or REITs could provide you the opportunity to profit from property without owning it personally. The majority of REITs are companies that own and manage income-producing real estate. There are many different types of REITs that own various kinds of real estate, such as residential real estate, commercial buildings like office and apartment buildings, warehouses, hospitals, shopping centers, hotels, and so on. Anyone can buy and sell publicly traded REITs. It's like owning real estate without the headaches associated with personally owning and managing property. As with any investment, it's important to choose a type of REIT that aligns with your investing principles. For example, retail REITs might be finding it hard to continually grow as retail demand decreases. In contrast, its possible healthcare could be thriving. The second major type of REIT is a mortgage REIT, which provides financing for income-producing real estate by purchasing loans from banks or originating mortgages in mortgage-backed securities. These companies make money by collecting payments and interest on mortgages instead of having to invest in property themselves. Some mortgage REITs focus on residential mortgages and mortgage-backed securities, while others focus on commercial mortgages and mortgage-backed securities. There are also mortgage REITs that hold both residential and commercial mortgages. Instead of buying a company that invests in real estate with the dividend being the rent checks, you are purchasing a company that profits from financing real estate. What makes these investments so different from other publicly traded real estate companies is that REITs have to distribute at least 90% of their taxable income in the form of dividends. This is because of the way IRS requirements work. They mean that a business will not pay tax at the corporate level, but instead the shareholders will be paying tax on the income received. Investors looking for income or cash flow can benefit from the dividend payments, which are mostly paid out quarterly. Some companies pay out monthly, but those are much less popular. Due to the fact that much of the money from REITs goes towards paying shareholders in dividends, it is unlikely that you'll see a lot of share price growth. However, annual dividend yields from REITs are usually higher than with corporations, and some pay 10%. When choosing a REIT that will fit the needs of your portfolio, it's important to purchase a company that invests in an asset that you think will be profitable in the future. For example, when retail demand is declining, you might purchase a REIT that invests in new homes or hospitals rather than one that invests in retail. It is also worth considering the volatility of the category of which the company is invested in. For example, a company that invests in new real estate might be subject to more ups and downs than a company collecting rent from hotels or hospitals. Buying REIT can be very similar to investing in stocks, which is why you want to make sure the company's fundamentals are good and has a promising future. If you're looking for an easier option than choosing a company yourself, real estate investment trust, index funds, and ETF are available through numerous companies, including Vanguard. Purchasing a REIT is as simple as buying an individual stock or ETF. You can do this with free brokerages like Robinhood or within your IRA. Keep in mind that dividends might be taxed differently than capital gains, so you might choose to invest within a tax-advantageous account. Some types of REITs also tend to perform well during times of low interest rates, as they can finance new property for a cheaper cost. Combine that with the fact that real estate has been a stable, well-performing investment in the past, and you might find it worth it to invest. REITs offer investors the ability to invest in real estate without the headache of owning and renting property themselves. They can buy and sell shares in a matter of minutes with ease. They can be a great choice for retirees seeking income in the form of dividends, or for investors looking to diversify their portfolio to decrease volatility by investing in real estate. Investing in real estate through a REIT doesn't involve a large down payment, non-paying tenants, or other disadvantages of traditional real estate investing. As a relatively stable investment, it could be a great way to build your portfolio. If this video was helpful, don't forget to like and subscribe. Hit the bell to never miss out when I upload a new video. See you next time.